Short exercise 10-3. So we're going to record depreciation for an asset using three different depreciation methods. On January 1st, 2024, Air Canadians purchased a used airplane for $37 million. Air Canadians expects the plane to remain useful for 5 years or 4 million miles, depending on which depreciation method they're going to be using. And it's expected to have a residual value of $5 million. The company expects the plane to be flown 1,400,000 miles during the first year. So as I've already done, I've opened up the requirements. So we want to calculate the depreciation using three different methods. Now, of course, in the real world, you're just going to pick one depreciation method and stick with it. So this exercise is giving us practice with three different methods. So requirement 1A, compute Air Canadian's first year depreciation expense on the plane using the straight line method. Begin by selecting the formula to calculate the company's first year depreciation expense on the plane using the straight line method. Then enter the amounts and calculate the depreciation for the first year. So our first task is to enter the formula in words. So do you remember what the straight line depreciation formula is? It's cost minus residual value. Some books call that salvage value, divided by the useful life in years. So we need to plug in the cost. The cost was 37 million up here. 37 with 6 zeros. 1, 2, 3, 4, 5, 6. Residual value, 5 million. So that's a 5 with 6 zeros. Or you can enter the commas. 5, 1, 2, 3, 4, 5, 6. The useful life is 5 years. So take 37 million, subtract 5 million, divide by 5 years. You get 6 million. I'll put the commas in there for you this time. $400,000 of depreciation in the first year. And for every year for a straight line. Excellent. Requirement 1B, compute Air Canadian's first year depreciation expense on the plane using the units of production method. So the units of production method of depreciation basically is the more you use something, the more it's depreciated. And how do you keep track of how much you use an airplane? It's by miles flown. So we need to plug in the formula in words first. So the formula is cost minus residual value divided by useful life in units. And useful life in units in this case is the number of miles we think this plane can be flown, and that's right up here, 4 million. So the cost, I just can double click the cost, copy and paste. Same with the residual value, copy and paste. We think the useful life in units, not years, is 4 million. So I'll enter the commas this time. Comma 1, 2, 3, comma 4, 5, 6. So if we take 37 million, subtract 5 million, that's 32 million divided by 4 million, gives us $8 of depreciation per mile flown. So we know the depreciation per mile flown is $8 per mile. So to calculate the first year depreciation, we need to take the depreciation per unit, which is $8, times the current year usage. How much did we use this plane in the first year? We expect to fly at 1,400,000 miles. So 1, 400, 000. So we take 8 times 1,400,000 and we get 11 million, 200, 1,000. So 11 million $200,000 of depreciation in the first year. Actually, we don't need this anymore. Requirement 1C, compute Air Canadian's first year depreciation expense on the plane using the double declining balance method. So double declining balance means they're multiplying it by 2, which results in a lot of depreciation in the early years, but it quickly goes down. So a lot of depreciation in the early years and little depreciation in the later years. So we need to plug in the formula in words. So the formula is cost minus accumulated depreciation, so this is something that a lot of students forget, times 2, remember it's double declining balance, times 1 divided by useful life. So now we can plug in the cost. The cost is up here, copy, paste. Accumulated depreciation. Now remember, this is the first year, so how much has been depreciated so far? None. So put a 0 in there, and then we're just going to bring down this times 2 times 1 divided by 5. And why is 5 on the bottom? Because that's the useful life, and we said the useful life for this airplane will be 5 years. So now we can do the calculation. We're going to take 37 million minus 0 times 2 times 1, so divided by 5. So then just divide by 5. So 37 million times 2 divided by 5 should give you 14 million, 800,000 miles of depreciation, dollars of depreciation in the first year. And now the last requirement, requirement 2, show the airplane's book value at the end of the first year for all 3 methods or scenarios. So remember, book value is just simply cost of the asset minus the accumulated depreciation gives you the book value. So the cost is the same for all 3 scenarios or methods, whatever you want to call them. And then, so let's work on a straight line. The accumulated depreciation, now remember we're doing this for the first year. So after 1 year, the accumulated depreciation is up here, 6,400,000. I'm going to copy and paste. We do the math, 37 million minus 6,400,000 gives us 30,600,000. 30,600,000. For the units of production method, we go up here for our depreciation. In the first year, we got 11,200,000. Copy, paste. We subtract that, 25,800,000. And double declining balance, we got $14,800,000 of depreciation in the first year. We subtract that from 37 million, we get 22 million, 200, 000. So 22,200,000. So if your boss had asked you to, if your boss said, well, we're thinking about getting this airplane, so run these 3 scenarios for us and see what the differences are. So the one that gives you the most depreciation in the first year is double declining balance. So remember, depreciation will be depreciation expense and accumulated depreciation. So if your boss's goal was to maximize expenses so you can lower net income, which would therefore lower taxes, then double declining balance would be what you want. If your goal in the first year is to have the least amount of depreciation, then you go with straight line depreciation. So lower depreciation expense would mean higher net income, which would mean higher net income. So it depends on what the executive's goals are for the company. That's it.